Namaste. In this video, we'll discuss about India's 115 that talks about the revenue from contract with the customers. So the revenue that is generated from the contract with the customer is covered by India's 115. There are some exclusions where the specific indices are issued for the revenue generation, just like lease, insurance, and financial instruments. So those are not covered. India's 115 specifically talks about the revenue that is generated from contract with the customers. This India's 115 is divided in a five-step model that talks about the generation of revenue from contract with the customer. So first we need to identify the contract. When we have identified the contract, then we need to identify the performance obligation. In the third step, we need to identify what is the transaction price for a particular performance obligation, and if there are more performance obligation in a contract, then we need to allocate the transaction price among the performance obligation. And fifth step is to recognize the revenue once the performance obligation has been satisfied. So apart from it, it provides some guidelines about the accounting of contract cost, contract modification, licenses, and other application issues also it discusses. Objective of India's 115 is to provide the useful information about the revenue and cash flow that those are generated from the contract with the customers. And the objective of this India's 115 is to recognize the revenue. So recognition will be when the goods and services has been transferred to the customers for a monetary terms. So it will be for the value of consideration expected in the exchange of the goods and services that we have provided. And we need to check the contract terms and facts and circumstances. And India's 115 provides a liberty to use practical expedient when we are recognizing the revenue. And we need to apply these rules consistently across similar contracts. If there is a more than one contract, for example, there are industries where similar number of transactions are done. So India's 115 provide us the liberty to use the portfolio approach using the practical expedient to apply Ind AS 115 instead of applying 115 to each and every contract individually. So if the result is same, if we use the portfolio approach, apply the Ind AS 115 to a group of transactions and the results is same, that we can use the portfolio approach instead of applying 115 to each and every contract. So the key point about the practical expedient is that this approach is optional, not mandatory, and it is a practical expedient because it reduces efforts but still produce the faithful revenue reporting. So if we summarize this, we need to think about what we are going to recognize, how much we are going to recognize, when we will recognize, and how sure we are about the collectibility of the revenue that we are going to recognize. So let's take some example about the practical expedient. For example, we are in telecom industry and telecom operator sells 10 lakhs prepaid SIM card recharge pack of 100 each with a identical term of 1 month. So it will be impractical in this case to apply Ind AS 115, review each and every contract with the customers. So, and it will not give any different result also. So we need to use the practical expedient and should treat all the recharge pack as a one portfolio. And revenue should be recognized systematically over the month of service. Similarly, in case of the subscription of newspapers, where the newspaper is subscribed for 500 per subscriber, so the each subscriber sign a separate contract, but terms are identical. So we can use the portfolio approach when we are applying the Ind AS 115 in these cases. Next is about the scope. So Ind AS 115 applies to all customers, all the contract with the customer except where the specific indices are issued for handling the issue, like in case of lease, Ind AS 115 is not applicable. Insurance contract, financial instrument and investments, and non-monetary exchanges between the same industry players to facilitate the customers. So, in case of non-monetary transaction, if it is within the same industry and to facilitate the transactions, in that case, Ind AS 115 is not applicable. But if it is not within the same industry or it is for the dissimilar goods, Ind AS 115 will be applicable. For example, if we take a swap of oil for oil, so it is within the same industry. In that case, Ind AS 115 will not be applicable because it is a transaction of similar goods. But if there is a oil swap for olive oil with the coconut oil, in this case, Ind AS 115 will be applicable because it is not within the same industry of similar goods and it is not to facilitate the customers. Apart from it, if some revenue transactions are not covered by Ind AS 115 because these are not from the contract with the customers, for example, dividend, donations, contributions, change in the fair value of biological assets, inventory of broker. Apart from it, the recognition and measurement applies on the non-financial assets, even not in the ordinary course of business. For example, derecognition and gain or loss on the disposal of assets and intangible assets are in purview of Ind AS 115, although they are not from the ordinary activities of the business. Reason being that it is specifically mentioned in the respective Ind AS. For example, in the para 68A and 69 of Ind AS 16, that gain and loss recognition will be covered based on the principle of Ind AS 115. So let's take some example of non-monetary exchange. So does Ind AS 115 apply to real estate developers? Yes, it will be applied to real estate developers. Earlier, there was one guidance note in this regard that was dealing with the recognition of revenue of real estate developers, but it has been withdrawn after Ind AS 115, so it will be applicable. A company is registered as an EOU and exports all its manufactured product. As per the foreign trade policy in India, MEIS, the company is eligible to claim 2% of its FOB value of export as export incentive in form of scripts, which could be used for payment of custom duty against imports or could be sold in open market. Can MEIS incentive be treated as revenue? As we have discussed that India's 115, as the name suggests, talks about the revenue from contract with the customers. In this case, government is not customer and the incentive that is providing is in form of government grant. So Ind AS 20 will be applicable, not Ind AS 115. Whether revenue from extraction of mineral ores will be accounted as per Ind AS 115. This is not in the exception, so it will be covered under Ind AS 115. Next is QTV release an advertisement in Deshbandhu, a daily newspaper. Instead of paying for same, QTV allow Deshbandhu a free advertisement spot which was duly utilized by the Deshbandhu. How revenue for these non-monetary transaction in the area of advertisement will be recognized and measured. So exclusion in case of non-monetary transaction is if it is within the same industry and to facilitate the customers. So in this case, both QTV and newspaper are using a different mode of media, so it will not be considered as an exception to exclusion from Ind AS 115 because it is a transaction is of dissimilar goods, so it will be covered under Ind AS 115 and the transaction will be recorded at fair value. A Limited and B Limited both are engaged in manufacturing of bottles. A Limited operate in northern, eastern and central part of India. B Limited operates in the western and southern part of India. A Limited fulfills a demand of its customer based on western and southern India by using the bottles manufactured by B Limited. Similarly, B Limited fulfills the demand of customers based on the northern, eastern and central part of India by delivering the bottles manufactured by A Limited. How A and B Limited should recognize the revenue? So in case of non-monetary exchanges, it is not covered under Ind AS 115 if the transaction is within the same industry and to facilitate the customer. So in this case, as the transaction is for the bottles and to facilitate the customers, so in this case it is just a transaction, just a exchange of goods and should not be recognized, revenue should not be recognized, and Ind AS 115 will not be applicable on this transaction. Next is entity A Limited and B Limited both are engaged in the extraction and supply of natural gas to different part of India. A Limited is located in Western India while B Limited is located in southern part of India. A Limited contract to supply natural gas to large corporate customers. XL Limited located in the southern eastern region who is engaged in supply of natural gas to homes. So this is supplying to corporate customers and this is supplying to homes, individual customers. B Limited on the other hand contract to supply natural gas to YS Limited which is located closer to A Limited. Consequently, A Limited purchase from the B Limited to supply of natural gas to YS Limited. B Limited purchase from the A Limited to supply natural gas to XL Limited. The price of natural gas for this transaction would be based on the actual delivery date of the gas by the either party. Further, the parties would do a monthly calculation of the supplies and receipt of the gas and do a net settlement based on the price calculated as above. In the said industry, the price varies based on the different product categories and also varies based on the point of sale. How will this transaction situation should be treated under Ind AS 115? So if we look about the non-monetary exchanges, it is exchanges of the goods between the same industry players to facilitate the customer. This was the condition. But in this case, if we see, it is not the exchange of goods. Both the companies are doing the transaction and the price of natural gas of this transaction would be based on the actual day delivery date of the gas. So this is not a non-monetary exchange. So it will be covered under, does fall under the scope of Ind AS 115 because exclusion will be where there is a only non-monetary exchange. Here there is a monetary exchange. Next, a limited telecommunication company entered into the agreement with B Limited, which is engaged in the generation and supply of the power. Agreement provide that A Limited will provide 1 lakh minutes of talk time to employees of B Limited. Okay, so A is providing the talk time and in exchange getting power equivalent to this much of units. A Limited normally charge 0.5 minute and B Limited charge 2.5 minute. How should revenue be measured in this case? So it is for the dissimilar goods. So Ind AS 115 applicability will be there and it will be based on the fair value. So current scenario will be covered under Ind AS 115. So let's come back to the same slide. Next, we need to discuss about the customer. A customer is that gets the goods and services from the entity's ordinary activities in the exchange for the consideration, and it will not be considered a customer if it is a collaboration or sharing risk benefit. For example, there is a joint venture to develop a asset, so it will not be considered and will not be in purview of Ind AS 115 because this is not a revenue from the customer. Customer is who gets the goods and services from the ordinary course of business. So customer is buyer of the output, not a partner in the efforts. There may be a mixed contract. If part of contract falls under any other Ind AS, then we should apply those Ind AS first and thereafter we should apply Ind AS 115. But if there is a no guidance in other standard, then we should apply Ind AS 115 directly. Then revenue, it is about the income arising in course of an entity's ordinary activities. But income encompasses the revenue as well as the gain, which may not arise in the ordinary course of the business. For example, economic benefit in form of increased cash flow, enhanced maintain the value of the asset, and decrease in the value of the liabilities will be called as income. So let's take one example for the differentiation of revenue and income. And before we go, let's revise it again. That revenue is the income that is arised from that arose in the ordinary course of the business, but income includes the revenue also and the other activities. Because of that, the cash flow has increased, or the value of assets has increased, or there is a decrease in the liability other than the contribution from the equity partners. So for example, there is a cement manufacturer and it sell the cement, so it will be covered under revenue and it will be covered under income also. But if there is a gain on sale of surplus of land, so it is not an ordinary activity of the entity, so it will not be covered under revenue, but it will be covered under the head of income, because income is wider. And contract is an agreement between two or more parties that create enforceable rights and obligation. So let's take some example on this topic also. For example, India's 115 do not meet the from the perspective of India's 115, below transaction do not meet the definition of contract with the customer, so India's 115 will not be applicable. Dividend we have already discussed. Sale of fixed assets outside ordinary course of business, but it is specifically mentioned under India's 115 that it will be covered under India's 115, but it will be gain or loss will be shown as a other income, not revenue. Government grant we have already discussed that it is not a income from contract of the customer, so will be covered under Ind AS 20. Donations, voluntary contributions and fair value changes, these are out of the scope of Ind AS 115 because it does not fall in the definition of the contract. Next is about the identifying the contract. So condition to recognize a contract is that there should be approval and commitment to perform. Contract must be approved. It may be orally written or as per the customary business practice. Both parties should be committed to fulfill the obligation only when Ind AS 115 will be applicable. So this is the first condition. So let's take some example about it. For example, a company signs a written agreement with a customer to supply 1000 laptops at a 30,000. So it is a written signed contract and legally bound. So Ind AS 115 will be applicable. For example, there may be oral agreement also. So as per a practice, if a local supplier and retailer have a long standing business relationship and one person call another to supply 500 kg of rice or something else and it is supplied and payment is also done. So as a customary practice, it will be called as a oral agreement and in AS, it is valid under Ind AS 115. There may be implied contract also. For example, in case of the cab that we are using, Uber, Ola, we do not sign any formal agreement, but by accepting the right, we are committed to the agreement and we are committed to payment also. So in this case, it is also a form of contract. And a customer sends an inquiry mail asking for the price quotation and supplier replies with the quotation, but customer has not confirmed the order. So in this case, there is a no commitment. There is a lack of approval. So there is a no contract. So Ind AS 115 will not be applicable. Similarly, let's take one another example. If there is a seller sends a price quotation and buyer has not accepted it, so there is a no commitment to perform. So the first condition of contract fails. So Ind AS 115 will not be apply. Next, if there is an option without the obligation. For example, customer reserve a hotel, and but there is an option that he can cancel anytime without any penalty. So there is a no enforceability, and it is not under purview of India's 115. Revenue will not be recognized. So the first condition of contract we have discussed, that there should be approval and commitment to perform. Next is that there should be identifiable rights of each party. The contract must clearly define each party's rights and obligations and what services and goods to be transferred. So let's discuss few examples about it. Software license and implementation. A contract states that vendor will provide a 3-year software license. It will provide implementation services and upgradation services. So it is clearly defined what are the rights of the customers. Next is real estate purchase. A flat purchase agreement states that builder will provide 2 BHK apartment, and the customer has right to inspect the construction progress and get the possession on completion. So customer's right is to get the flat, builder's duty is to deliver, and it is called clearly defined. Similarly, for gym membership contract state that gym will provide access to the facility and training for 12 months. Customer has right to use the gym during the working hours. So rights and obligations are clearly explicit. So this example where the test is failed, let's look into it. And a consultant sign a contract saying that I will provide a support whenever needed, but it does not specify that what support it will provide and how much and for how long. So rights are vague. So it is not valid under India's 115. Similarly, if there is an ambiguity about the product description, supplier agrees to provide some spare parts without specifying what type of spare parts it will provide, for how much quantity it will provide, and when it will deliver. So rights regarding the goods are not clear in this case. So hook line is, if the contract does not spell out who gets what, it is a contract under India's 115. Third condition is that the payment should be identifiable. Terms of payment should be identifiable even if the contract has no fixed duration and is cancelable, modifiable, or auto renewed, and we need to apply 115 if the terms are identifiable. So let's take few example of it. If there is a car sale agreement, a dealer sells a car for 10 lakhs that is payable in 3 installments. So pay term are clearly defined. Monthly subscription for streaming platform charges 500 rupees per month, auto renewed until cancellation, even though duration is not fixed. But payment terms are clear. That is, it is 500 rupees per month. So Ind AS 115 will apply. In case of real estate project, buyer agrees to pay 10% on booking, 20% when the foundation is completed, 30% on a structure is completed, and 40% at the time of possession. So schedule is determined. It will be called as a valid contract. Let's take one example where it fails the test, where price is unclear. A supplier agrees to deliver goods, but the contract says that price will be decided later depending upon the market conditions. So here the payment is not determinable and it is not a valid contract. Similarly, another example of fail of test is customer uses services now, but customer says we will negotiate payment terms in future. So in this case, there is no determinable consideration. So payment terms will not be called as a clear, and Ind AS 115 will not recognize it. So hook line is that no clear money, no contract. Unless you know how and when you will be paid, Ind AS 115 will not recognize it. Third condition is there should be commercial substance in the transaction that we are doing. So the agreement must affect the entity's future cash flow, its risk, timing, and amount. Only then Ind AS 115 will be applicable. If there is a no commercial substance, it will not called a valid contract for the purpose of recognition. Let's discuss some example about it. Export sale with forex risk. An Indian exporter sell goods of $1 lakh to US buyer. Even though the price is in INR that is not fixed, the contract affects the future cash flow because exchange rate fluctuation affects the INR valuation. So here it is called a commercial substance. It will be applicable. If there is a lease transaction, it will be applicable. Software development contract. A firm agrees to build a customer software for 50 lakhs and payable in milestones. Up and so there is the contract affects the future inflow. If there is a delay in the achieving the milestone, the payment will be delayed, revenue recognition will be delayed. So it will be a valid example of commercial substance. Failure test. If company A sells goods worth rupees 10 lakhs to company B with an agreement that the B will sell them back at the same price in 3 months. So if you see that A is selling goods to B and repurchasing it at the same price in a period of 3 months. So there is no commercial substance to this transaction. Similar, one more example. It is a case of fake sale agreement where parent company sells goods to a subsidiary, but a side agreement to reverse the transaction at a later on same price. So there is no real change in the risk, timing, and amount of cash flow. So it will not be called as a valid contract. Next example is barter with no cash impact. Two firms exchange similar advertisement space for equal value. Neither party's cash flow changes, so there is no commercial substance. And we have discussed in the area of scope also that if it is transaction of the similar goods is there to facilitate the customer within the same industry, it is out of the scope of India's 115. So if we look at the hook line, if a deal doesn't change your cash flow story, if because of the contract we are not going it is not going to affect our cash flow, risk, timing, and amount, it is just a paper, it is not a contract as per India's 115. Next condition, fifth condition is there should be probability of collectibility. If we are selling the goods and there is no probability of collection from the customer, it will not be considered for the revenue recognition. So there should be customer's ability and intention to pay. So let's discuss some examples about it. So established customer with a good history, a company sells medical equipment worth 20 lakhs to a hospital that has a strong financial track record. Then hospital has both the ability also and intention also. So it will be regarded as a valid contract and revenue will be recognized. Similarly, a telecom operator provide monthly services and billing customers worth 500 each. Even if some customer default occasionally, company expect to collect substantially all of the consideration, so it meets the probable collection requirement. Next is government tender. A government agency award a contract worth 50 crores to a customer. Government's creditworthiness assures ability to pay, and signing of agreement indicate the intention, so it is called a valid contract. This is example where we fails the test. A company enters into a deal with the retailer that is already under bankruptcy proceedings. Even if the contract term are agreed, it is probable that payment will not be received. So in this case, there is no contract because it fails the probability of collectibility test. Next is a supplier deliver goods, but the customer disputes about the amount as and has no intention to pay. So in this case also, the fifth condition of probability of collectivity get fails. So we will not recognize revenue. It will not be a valid contract from the perspective of India's 115. So hookup is a promise to pay is useless if the customer cannot or would not be paid. India's 115 requires both the ability also as well as intention to pay also. So if these two conditions are satisfied, only then revenue will be recognized. So if we see there are five conditions in respect of the identifying the contract, there should be approval and commitment to perform. It may be orally, writing, or customary business practices. And there should be identifiable rights of each party, there should be identifiable pay terms, and there should be commercial substance, and probability of collectability should be there. So if we summarize, it is about if a deal is not clear, it not substantial and collectible, then it is not a contract. So there should be commitment, there should be collectability, there should be substantial substance, commercial substance. In that case only it will be called as a contract. And contract does not exist if party has unilateral right to terminate unperformed contract without compensation, if goods and services are not transferred and not received or entitled to receive compensation. So if a party has a unilateral contract to terminate the unilateral right to terminate the unperformed contract without any compensation, in that case revenue cannot be recognized. For example, I have done a booking on makemytrip.com for a 5 days stay, but I have right to cancel the deal without paying any compensation. So in that case, hotel cannot recognize revenue because I have unilateral right to terminate the contract. So hook is that if one side can walk away free, nothing is delivered and nothing is owed. It is not a contract as per India's 115. So let's discuss some examples. A gym allow a customer to cancel 12 months membership at any time without penalty. Customer cancels after 2 months and gym has not received had not yet provided extra services beyond the excess already used. So there is no enforceable contract for the remaining period and revenue cannot be recognized. Similarly, a training institute signs up a student but allow cancellation before the course starts with the full refund. In this case, a student cancels and institute has not delivered any teaching hours. So it is not a contract as per Ind AS 115. And another example where goods are not delivered, a company accept an order for 1000 chairs, but the buyer can cancel before delivery without paying anything. So it is not a contract because buyer can walk away at any time. So for purpose of identifying contract, we need to check whether contract criteria have been met. If we have met the contract criteria, the five we have discussed in the earlier slide, we do not need to reassess that those criteria unless there is an indication of significant change in the facts and circumstances. For example, if there is a change in the customer ability to pay the consideration, only in this case we need to reassess the changes in the fact and circumstances. And if contract criteria have not met, in that case we need to keep on assessing the facts and circumstances to determine if the consideration is received before the contract exists. We need to keep on assessing to determine when the contract criteria are met. And if the consideration is received before the contract exists, before we enter into the contract, we have received the consideration from the customer, we need to recognize it as a liability. And we will recognize revenue only if there is no remaining obligation or consideration has been received and is not refundable, or contract has been terminated and consideration is not refundable. So if the contract criteria has been met, we are not supposed to reassess that unless there is a change in some fact and circumstances. Because of that, we need to revisit the contract criteria. And if the contract criteria has not met, we need to keep on reassessing to the facts and figures to determine whether contract criteria has been met. And before that, if we have received some consideration before we entered into the contract, we have received some consideration, so we need to recognize it as a liability. And this liability will be recognized as revenue only if this amount is non-refundable, and we are not supposed to any obligation and consideration, no remaining obligation from the part of the seller, and the contract has been terminated and this amount is non-refundable. Only in that case we will recognize it as a revenue. So question is, company A has a customer P which is undergoing restructuring due to issue related to liquidity. Company A has decided not to do any further business with P, and P has informed company A that it will get letter of credit from the nationalized bank against which the company can A can dispatch the goods. Company A has manufactured the goods exclusively for P, but the LC has not been arranged because it is in process. When should company A recognize the revenue? So one of the condition of contract is that there should be probability of collection. In this case, because A is in liquidity, although he has ensured that it will provide the letter of credit, but it has not provided the letter of credit yet. So the probability criteria is still not met. So we will not be able to recognize the revenue till it provides the LC. Next example is an entity G Limited enters into a contract with the customer P for sale of machinery of 20 lakhs. P Limited intend to use the said machinery to start a food processing unit. The food processing industry is highly competitive and P has a very little experience. So G Limited is entered into a contract with the P Limited to sell the machinery for 20 lakhs, and it is going to start a food processing unit, and P Limited pays a non-refundable deposit of 1 lakh at the inception of the contract and enters into a long-term financing agreement with G Limited. Okay. So there is a financing agreement with the G Limited for the remaining 95% of the agreed consideration, which it intends to pay primarily from the income received from its food processing units. As it lacks any other major source of income, the financing arrangement is provided on a non-recourse basis, which means that if P Limited defaults, a G Limited can repurchase the machinery, but it cannot seek further compensation from the P Limited. Even if the full value of the amount owed is not recovered from the machinery, the cost of machinery for G Limited is 12 lakhs. P Limited obtained control of the machinery at the contract inception, when G Limited should recognize the revenue from the sale of machinery to P Limited according to paragraph 9 of India's 115. So we need to look into the 5 conditions of contract. There should be approval and commitment to perform. Yet it is there. There should be identifiable right of each party. It is there. Identifiable payment terms. It is there. Commercial substance. It is there. Fifth condition is there should be probability of collectability. In this case, as P Limited is new in the food processing units, your food processing business, and has a little experience. So in this case, it is doubt that it will be able to pay the consideration to G Limited, so revenue will not be recognized. And 1 lakh payment that has been received by G Limited will be continue to account for as for the initial deposit as a future payment, as a liability. It will be recognized because there is a lack of probability of collection from the company, so revenue cannot be recognized. Next example is, on March 17, P Limited agrees to sell 1 lakh bath fitting to X Limited, which are manufactured by using customized screws supplied by the specific vendor. The payment term have not been decided as they are independent on the price of customized screw, which is to be finalized. As a token of confirmation, P Limited receives a non-refundable amount of 1000. How will this arrangement be treated under India's 115 in the books of P Limited if P Limited is a principal in this transaction? So the third condition in the identifying the contract is that there should be identifiable P term. So it is not identified, so it is not in the criteria of contract. So P Limited will continue to account for the non-refundable amount as a liability. Revenue cannot be recognized. Next is X Limited provides IT support services to his customer for a distance location. Customer call up the support team for X Limited who understand the client's requirement over the phone and provide necessary advice to the customer to resolve their issues. Before providing advice, the customer team support team will understand the client's problem and inform them about the price for the services to be provided. Once the problem is resolved, the customer will make the agreed payment to the X Limited through online booking banking mode. X Limited considered a location is probable and the oral contract is enforceable as per the law applicable in the jurisdiction of X Limited. In such case, whether there is a valid contract. So there are five conditions. There should be approval and commitment. It may be oral, writing, or customary business practice. So there is a approval. Identifiable right of each party, it is there. Identifiable pay term, it is there. Commercial substance is there. And probability of collection is there. So there is a contract as per Ind AS 115. So next topic is about the combination of contract. When we should combine the contract. So we should combine the contract if entered at a near same time. So what is the near same time? It is not defined in Ind AS 115. We need to use our judgment. So it is near the same time with the same customer and if one or more condition are met. For example, contract is negotiated as a package. So contract are negotiated together with a single commercial objective. In this case, we will combine the contract and price is interdependent. Consideration in one contract depend on the price or performance of another. So it is considered that it is negotiated as a one contract. And if there is a single performance obligation, goods and services promised in the contract are a single performance obligation. In that case, we will combine the contract. So who case if contracts are tied together by deal, price or performance, Ind AS 115 also tied them together. What is the meaning of this? Let's take some example about it. For example, there is a contract for construction and maintenance. A builder signs two contracts with the same client at the same time that it will construct a commercial complex and will provide a 3 years maintenance services for the complex. So in this case, it is negotiated as a package and customer views both as a party as a part of one deal. So we should combine this contract. Next is equipment software installation. A company sells medical equipment for 50 lakhs and software for 10 lakhs and also sign an installation contract for 5 lakhs. So contract are negotiated together and customer cannot use equipment without the software and installation. So in this case, the purpose of negotiation is a package. So we should combine this contract. So if there is interdependent pricing. For example, company A enters into contract with the customer and that supply raw material at rupees 100 and consultancy services is provided 5. And if customer do not buy raw material, in that case, consultancy services will increase to 10 lakhs. So in this case, the price is dependent on another contract. So it means the substance of the deal is that it is a combined contract. So should be combined. So next is where there is an independent sale and service. A company sells a laptop to customer for 50,000. 6 months later, the same customer signs a separate annual maintenance contract of 5,000. So these two contracts were negotiated at different times with a separate objective. One is to purchase the laptop and another is for the maintenance contract and it is not negotiated as a package. The price is dependent, not interdependent and it is not a single performance obligation. So in this case, we are not supposed to combine the contract. So contract will be combined whether when it meets either one or more condition. First is whether it is negotiated as a package. Second is price is interdependent. Third is if it is a single performance contract obligation. Next example is A construction company signs a contract to build a warehouse. A month later, customer separately order office furniture for 10 lakhs. So if we look, contract do not have a single commercial objective and it is related to different goods and services, so should not be combined. Next is contract 1 is to supply steel at 100 kg. Contract 2 is signed later to deliver cement. So both are different goods. Prices are independent, not interdependent. Okay. So it should be account as a separate. Fourth is next contract example is an IT company signs a contract to develop a mobile app. Later on, same customer sign another contract for HR payroll softwares. So here the different performance obligations are there and these are for unrelated projects, so should not be combined. So outline is if there is a same customer doesn't mean the same contract. Only combine when the contract are linked by deal, price or performance obligation. Otherwise, we need to keep them separate. Let's take some more examples about it. Company A manufacture that is a manufacturer of specialized construction equipment enters into a contract with customer B to manufacture and deliver a customized boom lift for 95,000. A total cost to company A of designing this is 70,000. 2 days later, company A enters into another contract with customer B to deliver 4 boom lift tires. Earlier was for the boom lift. This time it is for the tires of boom lift. We will use the customized boom lift in the future after original tires deteriorate and the contract price per tire is 800. However, the cost of each tire is 900. Whether these two contracts should be treated as a single contract. So as we have discussed about the criteria of combinations, so if it is entered at a near time, yes, it is entered at a near time. It is entered with the same customer. So we need to check for rest three conditions. Whether it is negotiated as a package? No, it is not negotiated. Whether price is interdependent? No. Yes, price is interdependent because seller has agreed to sell it at 800. Otherwise, it would be cost of this tire is 900. It provides the indication that it is negotiated as a package. Although at different time, but the intention is same. It is third is it is a single performance obligation. So if we look that it is negotiated, although there are two contracts, but are negotiated as a bundle with a one business objective. So we should combine it. Company A would have incurred a loss of 400 if it was not combined with the first contract. And the tire would not have sold at a loss of 400. So the intention was a negotiated package. So we should combine this contract. Next is about the contract modification. A contract modification is change in the scope of the price. Change in the scope or the price or both of a contract that is approved by the parties. It can be written, it can be oral, it can be by customary business practices. So we need to check whether the scope or price of a contract changed with the customer approval. So the change is not with the customer approval, there is no modification. And if the change in the contract is with the approval of the contract, then we need to check whether it is for the distinct goods and services. Modification in the contract is for the distinct goods or services. So what is the distinct goods and services? It is distinct if these goods are capable of being distinct and customer can benefit on its own or with the readily available resources. For example, there is a contract for supplying 1000 laptop, and there is a modification in the contract and the customer says supply 10 more laptops. So rest 10 laptops can be used by the customers on its own. It is not linked with the earlier supply. So it will be called as a distinct. And it is distinct if it is separately identifiable in the context of the contract. So we need to check two things. First, we need to check whether the modification in the contract is capable of being distinct and customer can benefit on its own or readily available resources. Second, we need to check what is the intention of the contract, whether the services and goods are highly integrated, highly customized, or highly interdependent. So in that case, it will not be distinct. But if the additional goods and services, the additional scope of the contract that has been changed is not integrated, not customized, not highly interdependent, in that case, it can be called as a distinct. So if the scope and price of the contract has changed and it is with the approval of the customer and it is for the distinct goods and services, and second is it is at the standalone selling price. In that case, and this standalone selling price can be can be adjusted up to a minor level for the purpose of cost that seller is not going to incur. So main two things are there. The modification should be approved by the customer and it should be for distinct goods and services and at standalone price. So in this case, standalone price is price at which party sell goods and service separately to the customer. For example, the market price of a laptop is 50,000. So that will be anyone going to the seller and can buy a laptop at 50,000. It will be called as a standalone price. So if there is a change in the scope of the contract and it is approved and it is for the distinct goods and services and the price is a standalone price, in that case we should treat this modification in contract as a separate contract. And if there is a change in the scope of the price and it is approved by the customers, but it is not for the distinct, but either of the condition fail, whether the distinct goods and services condition fail or standalone price fail. In this case, we need to check further, are the remaining goods and services distinct from the those already delivered? So if the answer is yes, it is distinct from the goods already delivered. In that case, it means the price is not the standalone price. In this case, we need to terminate the old contract and need to create a new contract. So it will be called as a prospective adjustment. But if answer is that it is not distinct from the goods already delivered, in that case, we need to account as a part of existing contract and it will be called as a retrospective adjustment. Let's discuss it again. First is if there is a contract modification and contract modification is in form of scope or price or both and it is approved by the parties. So first we'll check whether there is a change in the scope of price is approved. If it is not approved, there is a no modification as per India's 115. And if it has been approved, then we need to check both the two conditions whether goods are distinct and prices are standalone price. So what is the meaning of distinct goods? That there are two further conditions that it can be, it is capable of being distinct, that customer can use these assets on its own with the available resources. So it will be called as a capable of being distinct. Second condition we need to check separately identifiable. within the context of the contract. It means it is not integrated, not customized, or highly interdependent. If both the conditions are satisfied, it will be modification will be treated as a separate contract. If any of the condition fails, we need to check whether the remaining goods and services are distinct from the already delivered. If goods are distinct, in that case, we will account for as a termination of old contract, and change in the standalone price will be treated as a prospective adjustment. But if it is a only increase in the scope and the goods and services are not distinct, in that case, we will adjust it as a retrospective adjustment. So let's discuss. So next is if there is a dispute. So contract may exist, modification might exist even if there is a dispute about the scope and price. And the if scope has been changed but the price has not been determined, the price change entity shall estimate the change to the transaction price arising from the price, and based on that it will book its income. So let's discuss some examples related to it. It is a very good and complex concept. So let's further decode it. If there is an example that builder sign for 10 houses, later customer add two more houses at current market price. So in this case, we need to check whether these two houses are distinct goods. Yes, this is distinct goods because it can be used separately. There is no highly interdependency in perspective of contract also. So two conditions are satisfied. And it is at standalone price because it is mentioned that it is current market price. So we need to, what the treatment will do, we will treat as a separate new contract. Reason is the goods are distinct and at a standalone price. So what may be the change factor that will change the answer? If, because first condition is to check whether goods are distinct or not, so it is distinct. So if the current market price, standalone price is changed, so it will not be treated as a separate contract. So here two conditions are satisfied. One is goods are distinct and it's at current market price, so it is considered as a separate contract. If this condition is changed, the answer would have been different. So this is about the separate contract. Next, if we look, the IT firm contracted to deliver 5 apps for 5 crore. After delivering 2 apps, customer requests 3 more apps at a bulk discounted rate. So, in the earlier example, there was a standalone price. In this case, first we need to check there are two conditions, whether it is a distinct, yes, application are distinct because these are not interdependent. It can, customer can take benefit on its own. But second condition here fails because it is not on the standalone basis price. So in this case, if it is not on standalone price, we need to check whether goods are distinct. Yes, goods are distinct. So in this case, we need to terminate the old contract and create a new contract for the 6 app. Here, if you see, the first condition was if it is distinct goods, yes, it is distinct goods. The price reflect standalone price? No, it does not reflect. In this case, we will check again whether it is for distinct goods. Yes. So in this case, we will do the prospective adjustment. So in this case, we need to account prospectively. We need to terminate the old contract and create new contract for 6 app. Reason is it is distinct. So what will change the answer? If the new app were not distinct, it would have catch-up adjustment. So if the goods would not have distinct, the first condition was failed, and because the goods were distinct, so we terminated it as a treated as a prospective adjustment. But our answer would have been changed if these goods would not be distinct, and in this case we need to do the retrospective adjustment. So next is the contractor building a bridge, and midway scope changes. Customer request to widen the bridge and price renegotiations are done. So let's check our decision tree, that yes, there is a modification, it is approved, it is distinct goods or services. So for this purpose, we need to check whether capable of being distinct, customer can benefit on its own with readily available services. So it is not, because work is single. Contractor is a building a bridge and it says to widen it. So the modification in scope is not being capable of distinct. So we need to check if it is not distinct. In that case, we need to do the retrospective treatment. So let's check the answer. In this case, yes, it is a single performance obligation and we need to cumulative catch up retrospective transaction we need to do. So what would have changed the answer if instead of customer ordering a new flyover nearby distinct work, it would change the answer. Next is real estate builder contracted for 100 crore project. Midway customer requests extra floor, but price negotiation is going. So in this case, modification enforceable, estimate price as a variable consideration until final approval, and para 19 allow estimation, but prices are not fixed. But modification can be done. Next is customer request an extra service but has right to cancel without any compensation. So as it does not fall in the definition of contract, it will not be called as a contract definition because there is a no enforceable right obligation and there will not be any accounting. And if there will be legal accounting, then yes, the answer would have been different. So let's discuss some more examples. Entity AB enters into a 3-year service contract with customer CD Limited for 4,50,000, 1,50,000 per year. The standalone selling price for 1 year services at the inception of contract is 1,50,000. AB Limited accounts for the contract as a series of distinct services. At the beginning of third year, the party agrees to the modification of contract. Okay. The fee for the third year is reduced to 1,20,000. And the CD Limited agrees to extend the contract for another 3 years at a rate of 1 lakh per year. Standalone selling price for 1 year services at the price of modification is 1,20,000. So at the beginning of third year, they modify the scope of work and price also. Scope was increased to 3 years and the price was reduced to 1 lakh, where the standalone price is still 1,20,000. So we need to check our decision tree. So does the modification adds a distinct goods and services? So for distinct goods and services, it is distinct because customer can benefit from its own. Yes, it is distinct. Second condition is price reflect standalone price. No, price is not reflecting standalone price because the price has been reduced from 1,20,000 to 1 lakh. So in this case, we need to check that are the remaining goods and services distinct? Yes. So in this case, we need to terminate the old contract and should create a new contract. So let's see our answer. So it should not be accounted for a separate contract because the price of contract did not increase by the amount of consideration that reflect the standalone price. The modification would be accounted for from the date of modification as if the existing agreement was terminated and new contract was created. So it will be on prospective basis. So we discussed that it will be on prospective basis. So accounted as termination of old and creation of the new contract. Next is Bob Limited, a construction company, enters into a contract on 15th April 2017 to construct a commercial building for Lee Limited on a land owned by Lee Limited for a consideration of 20 lakhs. The expected cost of construction is 14,000 as per agreed 14 lakhs. As per the agreed terms, if the building is completed within 24 months, that is by 2019, then Bob Limited is entitled for a performance bonus of 4 lakhs at a year end. Bob Limited has satisfied 60% of the performance obligation on the basis of cost incurred. In June 18, the Bob Limited and Lee Limited agreed to modify the contract by changing the floor plan of the building. As a result, the fixed consideration and expected cost increased by 3 lakhs. Consideration increased by 3 lakhs and the expected cost is increased by 2 lakh 40,000. In addition to the allowable time for achieving the performance, bonus is also bonus of 4 lakh time period is extended by 6 months. So now up to 14th October 2019, if he completes, then it will be eligible for the bonus. How should the Bob Limited account for this contract modification? So in the year 1, at the inception of the contract, in the given case, at the contract inception, Bob Limited will exclude the bonus because it cannot conclude that it is not sure about the probability. So the answer setter has considered that Bob Limited is not sure that whether it will be able to complete within the defined timeline. So it has excluded the bonus. And in case of year 2, it says that bonus in the transaction will not result in a significant reversal because it has completed 51% of the work. So in assessing the contract modification, B Limited evaluate and it concludes that the remaining goods and services to be provided using the modified contract are not distinct goods and services on or before the date of contract modification. The contract remain a single performance obligation. So it will be booked on a proportionate basis. Next example is a entity promises to sell 120 product to customer at a 1,20,000, 1,000 per product. The product are transferred to customer on a 6 months period. Okay. The entity transfer control of each product at a time. After the entity has transferred control of 60 product to the customer, the contract is modified to require the delivery of an additional 30 products at a price of 950 per product, which is standalone selling price of such additional product at a time of placing the order. The additional 30 products were not included in the initial contract. So determine the accounting for the modified contract. So first we need to check whether the contract modification is approved. Yes, it is approved. Then we need to check whether it is for the distinct goods. Yes, it is for the distinct goods. And second condition is whether it is for the standalone price. Yes, it is for the standalone price. So accordingly, the contract modification for the 30 product is in effect a new and separate contract for future product because both the condition has been satisfied. It is for the additional good distinct goods and at the standalone selling price. Next example is on 1st April X1 KLC Limited enters into a contract with Mr. K to provide a machine for 2.5 million and 1 year maintenance for 55,000 per month on October. KC Limited, KLC Limited and Mr. K agreed to modify the contract to reduce the amount of services from 55,000 to 45,000. Determine the effect of change in the contract. So we need to check again whether it is approved. Yes, it is approved. Both party agree to it. Now two conditions are whether it is a distinct goods and services. Yes, it is a distinct goods and services. And whether it is at standalone price, now the price has been reduced. Standalone price was 55,000. So KLC will account for the contract modification as it was a termination of the existing contract and it is a creation of new contract. Because if the one of the condition of distinct goods and standalone price is not met, in that case we need to check further whether it is a distinct goods. Yes, it is a distinct goods because it is about the maintenance services. So 6 months services has been provided and next 6 months are different from the earlier 6 months. So in this case, if it is for the distinct goods, so and not on the standalone price, in that case we need to treat it as a termination of old contract and creation of new contract. So the prospective adjustment will be done. Next is Growth Limited enters into an arrangement with the customer for infrastructure outsourcing deal. Based on its experience, Growth Limited determines that customization of infrastructure will take approximately 200 hours to complete the project and charge 150 per hour. After incurring 100 hours of time, Growth Limited and the customer agreed to change the aspect of the project and increases the estimate of labor by 50 hours at the rate of 100 hours, determine how contract modification will be accounted. So similarly, we need to adjust in the revenue because the goods and services are not distinct, but the price is distinct. So we need to, sorry. So we need to do the catch up adjustment in this. Next is second step is for the identifying the performance obligation. So at the contract inception, the entity must identify what the promise is in a contract so that we can identify the performance obligation. So promise can exist in form of explicit promise. It is written in the contract. It may be in form of implied promise, customary practices, policies, marketing, customer expectations. So it can be in both way. Similarly, we need to check whether the activity is a real promise or not. Only promise that transfer goods or services are performance. Only promises that transfer goods and services are called performance obligation. Set up and administrative tasks are not called as a performance obligation. So when the revenue is recognized by transferring a promised goods and services to customer when customer obtain control of the asset. And for the purpose of control, we need to check whether there is a ability to direct the use of the goods and services. Customer obtains substantially all the remaining benefit of the assets and it has ability to prevent others from the directing use or from directing the use and obtaining benefit from the assets. So we will recognize revenue when the goods and services have been transferred and customer has take the control of the asset. So India's 115 talks about the control of the assets, not about the risk and rewards. So we need to check from the perspective of the transfer of the control and transfer of control results when there is a ability to direct the use where the customer can obtain substantially all the remaining benefits from the assets and it can prevent others from the by directing it can prevent others from directing the use and obtaining benefit from the assets, then in that case we can recognize the revenue. So let's discuss few examples. Entity A license customer relationship management software to a client B. Entity A licenses customer relationship management software, okay, to B. In addition, entity A promises to provide customization services to significantly customize the software as per the client requirement. Okay. Whether software license can be considered as a distinct performance obligation or would be bundled among the customization services in the following scenario. Scenario 1 is client B has floated a single request for proposal for procurement of the software and customization services. The client's requirement is to receive a completely customized solution. So it is asking about whether it can be a distinct goods and services. So client B has a floated a single FRP. The client's requirement is to receive customized solution. So in this case, software is not a distinct, and A would account for the license customization fees together as a single performance obligation. Scenario 2 is client B has a floated separate FRP for the procurement of the software and customization service. There are third party service provider providing the customization service. Also, license contract is non-cancelable and payment are non-refundable. So in second scenario, it has given two FRP. Entity A concludes that the criteria is met because client B can benefit from the software together with readily available resources with other than entities A customization services and can benefit from the customization services together with the software transfer. Entity A also conclude that its promises to grant the license to provide the customization are separately identifiable. The entity conclude that the software license and customization services are not input to a combined item in the contract. On the basis of principle, the factor. So entity A considered that the client B has a floated a separate RPA for license of the software and customization services. So for being a distinct goods and services, we need to check two conditions. First, that whether the customer is capable of being distinct, whether the goods and services are capable of being distinct. It means that customer can benefit from its own or with the readily available resources. Second condition, we need to check whether it is separately identifiable within the context of the contract. So it means that it is not highly integrated, highly customized, or highly interdependent. If it is, then it is not distinct. XYZ Limited develop a software product A. A customer enters into a 3 years contract with XYZ to access the software in a hosting arrangement. The standalone selling price of product A is 5 lakh. The monthly fee for hosting the software is 25,000. Following are the additional facts. The customer has the enforceable right under the contract to take the possession of the software A at any time for no additional fees, and if he does so, will no longer be required to pay 25,000 monthly fee. So it is in hosting agreement, but if it pays for the software, it will not be required to pay the hosting fees. Second is if customer take possession of product A, it loses the right to the future unspecified updates. However, the updates infrequent and updates are typically minor, not integral to the maintaining the utility of the product. So it means the customer can capable of taking benefits on its own. And the incremental cost of electing to take possession of the software product A from XYZ would not be significant in comparison to the hosting services it would avoid. So if it elects to take possession of the software, it has to pay 5 lakhs, and customer thinks that the price is not a major, will not have a major impact because it is paying 25,000 per month and it will be no loss in taking the possession because it will save the hosting fees of 25,000 per month. So whether the license be considered as a distinct performance obligation from that of the hosting contract, will the answer be different in a situation where the upgrades and the features are integral to the overall functionality of the product A. So there are two conditions for being distinct. that capable of being distinct. It means the customer can take benefit on its own or with readily available resources, and it is separately identifiable within the context of the contract, not integrated, customized, and highly interdependent. So in this case, the conditions are met. So because the it can take possession and the upgrades that it is providing are not integral to maintaining, and it is also cost effective, will not have significant impact on the cost if it take the possession. So both the conditions of being capable of being distinct and separately identifiable, not integrated, not customized, not highly interdependent, so it can be called as a distinct. But in the second condition, if the upgrades are integral to the overall functionality of the contract A, in that case, the separately identifiable condition will not be met because it will be highly dependent on the updates, and it will not be useful to the customer with the available resources because it will lack the updates that is integral to the overall functionality of the product A. So condition of being distinct will not be met, right? Next is B Limited provides a hosted software solution to the customer for which customer pays a monthly fee. Customer enters into a contract to use software as a service model for 3 years. Customer are not permitted to take possession of the software. Okay. As a part of contract, B Limited agrees to provide a variety of services to customer prior to the using SaaS services. These services include training customers personnel, converting and migrating customer data from its current on a premise solution to be limited hosted environment, and building an interface to the permit the hosted application to supply data to customers. Premise general ledger system. Each of these services is a value to the customer on a standalone basis. Most of these services need not to be performed if hosting provider is changed. Be limited regularly sells SaaS separately without additional services. There are third-party consultants that provide each of these services. Whether SaaS software and other services are distinct obligation. So for being distinct, we need to check two things. Capable of being distinct, whether customer can take benefit on its own or with the readily available resources. Second, separately identifiable within the context of the contract. So what is the context of contract? Whether it is integrated, customized, interdependent, what the customer wants. So we need to check from that perspective. So in this case, the capable of being distinct condition is met, but the context of the contract, when we check what contract says, it is not met because entity concludes that SaaS and additional services are not input to a combined item in this contract on the basis of principle of fact. In reaching this conclusion, we consider that a customer could separately avail the additional services without significantly affecting its ability to benefit from the SaaS. So it says that both conditions are met. As a current scenario, the service performed by B Limited are not essential for the performance of SaaS as a B Limited sells SaaS separately to other customer, and there are other consultants who could provide the services. In accordance with the above, as a service as standalone value and need not to be performed if the hosting vendor is changed, B Limited concludes that its promise to provide each of the services in the SaaS are distinct performance obligation. So next is an entity. Polo Limited grants a customer a 3 years term license to antivirus software and promise to provide the customer with when and if available update to that software during the license period. Polo Limited frequently provide updates and that are critical to the continued utility of the software. Without updates, the customer ability to benefit would decline significantly during the 3 years. So whether the antivirus software update be distinct? No, because the first condition of being distinct, capable of being distinct, customer can benefit on its own or with readily available resources, is not met. So it is not separately identifiable. The fact that benefited customer can derive from the license on its own is limited because the customer ability to continue to use of software is rapidly changing is also considered in assessing whether the condition in 20 second condition is met or not, because the benefit that customer could obtain from the software over 3 years without the updates will significantly limited, so the second condition will not be met, so it will not be considered as a distinct services. Third is determination of transaction price. So amount, what is the price? Price is the amount that entity expect to be entitled to based on the contract or customary business practices. So it talks about the expectation that entity entitled to based on the contract and the customary business practice. So it is a three-step model that we will discuss for determining the prices. First is there should be identify promised consideration. This promised consideration can be fixed, it can be variable, but when determining the promised consideration, if we are collecting something on behalf of the third party or the government, for example, GST, we are collecting, we need to exclude it because we are collecting it on behalf of the third party. So we need to exclude it. And there are some assumptions also. So we need to assume that agreement contract is performed as agreed, and we need to ignore cancellation, renewals, and modifications, and we need to adjust for five key factors that we will discuss later. So let's first understand these three concepts. So what is the expectation and what is the promise consideration and about the assumptions. So first scenario is car is sold for 10 lakhs and GST is collected 1.5 1.8 lakh. So what will be the promised consideration transaction price? It will be 10 lakhs because 1.8 lakhs we have collected on behalf of the government. So if we collect including GST 11.8 lakh, it is an incorrect treatment. Next is software license we sold for 25 lakhs. So transaction 5 crore, sorry. Transaction price will be 5 crore. And if we reduce anything because of possible discounts and something, it will not be a correct accounting treatment. So if FMCG sells goods at MRP of 100 and it provides 10% customary rebate. So in this case, there is an expectation of customer to get 10% discount that seller provides on a customary basis. So we need to recognize revenue at 90. And if we recognize revenue at 100, it will not be correct. Next is if we sold car for 10 lakhs with a 7-day return warranty. So we need to assume full 100% uh, and we need to create refund liability separately. And if we reduce the price at 9, it is incorrect. Next is transaction price measurement. So we need to adjust the transaction price for variable consideration. So what is variable consideration? It may be discount, rebates, refund, bonuses, penalties, or contingencies. So we need to estimate these things by expected value, probability, most likely amount, and we need to apply these concept consistently. And we need to record refund liability if refund is expected. As we have discussed in the case of the car transaction, that we need to book at a total value and need to adjust it for a, or need to recognize a return liability. So let's take some example of variable consideration. For example, builder provides a bonus of 2 crore if project is finalized. So in this case, we need to estimate using the expected value or most likely outcome, what will be the chances of collecting bonus, and if there is no chance, we should not recognize it. So wrong treatment if we record it full bonus, if even if it is unlikely to receive it. Next is FMCG rebate 5% if sale exceeds 10,000 units. So in this case also we need to estimate based on the two approaches that we have discussed, expected value or most likely value, what will be the output, and accordingly we should recognize it. And ignoring the rebate is incorrect treatment. So we need to book it on a estimate basis. Next is if product is sold with a return option. In that case, we need to reduce the revenue for the expected return. We need to expect, we need to find out how much amount will be amount value of the sale will be returned. So based on the expected value or most likely method, and accordingly we need to reduce the revenue and should create the refund liability. And if we don't do, we'll recognize the full revenue, it will be a incorrect treatment. Next is if IT project with a penalty clause, again we need to find out, we need to judge what will be the possible outcome, and based on that we should recognize the revenue. Next is we have discussed the variable consideration. Next is constraint on the variable consideration. For example, we need to include only highly probable and there is chances of no reversal. If there are chances of significant reversal, then we should not recognize the revenue. Next is factors may be because of the market volatility, long uncertainty, limited experience, may be the constraint while recognize the revenue, and reassess if factors changes on yearly basis. Reassess the constraint if the facts change, or we need to check it on yearly basis. Let's take some example. For example, there is a royalty on pharma drug sale. So sale cannot be recognized. It is out of the, it's in depends on the customer how much sale will be there. So we need to recognize the royalty when actual sale happens, not based on the estimated future sale. If contractor bonus depends on the weather, so this is a constraint recognition. So we should not recognize bonus in advance. Similarly, if there is a startup with no history of returns, it's a new business. So we should not recognize revenue until evidence builds. Or we can book based on the industry practice. And if there is a telecom offering frequent price concession, so this is again a constraint upfront. We should recognizing full billed revenue only. Next is about the significant finance. If there is a significant finance component, in that case, we need to adjust the time value of money if timing does not match with the delivery. If there is a price that is adjusted for the time value of money, then it is called a presence of significance finance component. Finance benefit may be explicit or it may be implied in a contract, And if a period is less than 1 year, then India's 115 provides an option not to separate the financing component. But if the period is more, then we need to recognize the finance component. And we need to recognize interest separately, and it will not be called as a revenue because it is not from the ordinary course of business. No financing if paid or delay is due to the customer discretion. If customer has paid, it is not in the agreement, but it has paid in advance and deliveries is after 2 years. That then it will not be called as a financing component. And variable consideration based on the future demand or performance protection. If I am going to buy a car and the car owner says that delivery will be after 15 months, but to book the car I need to pay token amount of 15,000. Price of car is 20 lakhs. So it is a performance of protection. So it will not be called as a financing component. And use discount rate that reflect the customer specific credit risk. And once we have applied it, we will not update it later. So let's discuss some example related to significant financing components. A machine is sold at 1 crore that is payable in 3 years. So we need to discount to present value and recognize interest separately. And recording 1 crore revenue immediately is a wrong treatment. Similarly, prepaid SIM pack 500 uses at customer discretion. There is no financing. So adjusting for time value is unnecessary, and royalty that is payable after 3 years. This is also not financing because it is related to the variability and factor that is out of the control. Though variable, so royalty will not be adjusted for the time value of the money. Next is builder retain 10% until defect liability. So there is no financing, it is a performance protection as we have discussed in case of the cars. And car sold on deferred payment of 3 years. In this case, there is a financing treatment because car is sold, but payment is to be received after 2 years. In this case, we need to discount at customer specific rate. We need to separate the financing component and should recognize as a interest revenue. Next is non-cash consideration. So we need to measure it as a fair value. If it is not reliable, then we need to use standalone selling price, and it includes the customer contributed goods and services if it takes the control of the goods and services. If fair value varies due to performance, that is change in the fair value of shares, apply variable consideration guidelines. So let's discuss few examples of it. So if customer pays with the shares, we need to measure fair value of the shares and ignore the, if we don't book at a fair value, it will be a wrong treatment. Next is customer provides still for consideration. So we need to recognize it as a non-cash consideration, and ignoring contribution of steel will be a wrong treatment. And land given in exchange for the building, we need to measure land at a fair value, and recording only on construction cost will be a wrong treatment. So we need to consider the fair value of the land when we are recognizing the consideration for the contract. Next is shares received varies with the milestones. So we need to apply the variable consideration guidelines, and recording fair value without apply constraint will be a wrong treatment. And customer provides labor. In this case also we need to treat it as a non-cash consideration, and if we are not doing it, it is a wrong treatment. It will lower the consideration of the contract. Next is consideration payable to the customers. So if there are cases where cash, coupons, credits, paybacks are provided, so we need to reduce the revenue. in these cases, because these cases are two performance obligations. If we are buying something and customer is the seller is giving an option to avail 10% discount at next purchase that he is not providing to all, in that case the 10% value we need to book as a separate performance contract. In exception, if distinct goods and services are from customers, if it is for the distinct goods and services from the customer, and we need to recognize reduction where related revenue is recognized or payment is promised. So in this case, we need to reduce the revenue. For example, FMCG pay retailer 10 lakhs promotion allowance. So we need to reduce the transaction price. If we don't do, we book at a marketing expense and book full revenue. It is not correct. And auto companies pays clear dealer incentive per unit. So we need to reduce the transaction price in this case, and recording incentive as a selling expense is not correct. And distinct services from the customers advertising worth 5 lakhs. So we need to treat as purchase, not a revenue reduction. So we need to reduce the revenue. Oh, sorry, reducing the revenue despite distinct services is not a correct way. So next is the, if coupons, vouchers given to customers, we need to reduce the transaction price, and recording full sale plus separate coupon expense is incorrect. Next is retailer credit notes. We need to reduce the transaction price, and ignoring effect in the revenue is incorrect practice. So let's discuss some examples related to determination of transaction price. A car manufacturer sell a car for 1,20,000. That is inclusive of GST of 20,000. What is the amount to be recognized as revenue? In this case, it will be recognized as at 1 lakh. Can the amount of revenue recognized for a particular transaction in the financial statement be different from the amount of sale for the purpose of GST? Yes, it can be, because in case of the financial transactions, financial component is there, it can be different. If there is a sale made with a deferred consideration over 5 years for a value of say 1 lakh, the sale value of purpose of GST could be 1 lakh, but the revenue for the purpose of financial reporting will be the value after excluding the financing agreement for the deferred consideration. A TV manufacturer sells TV to its dealer at a price of 10,000 per TV. If a dealer take more than 8,000 sets during the contract period, then it is eligible for discount of 5% on the list price retrospectively. The contract period starts in June and ends in May of each year. On the reporting date, a particular dealer has purchased 5,000 sets. Based on the past trend, it is expected that the total purchase to be made by a dealer during the contract period up to May 2018 will be more than 8,000 sets. Should the revenue be adjusted for the discount? Yes, the revenue should be adjusted. Amount of revenue should be adjusted for the probable discount, because it is probable that he will buy more than 8,000 sets where 5,000 discount will be applicable. On April 18, X Limited enters into contract with Y to sell the mobile charger 100 per charger at a term of contract. If entity purchases more than 1,000, so it will, the price will be reduced to 90 rupees per unit. It will be reduced from 10 to 100 to 90. In September, entity sold 95 chargers. So entity expect that Y's purchase by March 19 will not be exceed the required threshold of 1,000. Yes. But in 18 October, Y acquires C, and entity X sells additional 600 charger to entity Y due to these developments. So entity need to update its estimate, and it estimates that it will exceed the 1,000. So we need to check whether we need to book it as a separate performance obligation or similar. In this case, the quotes are not distinct. It is on the standalone price. So we need to do the adjustment retrospectively. So in this case, sorry, not retrospectively. In this case, we need to book it as a should treat as a separate contract. So, in accordance with the above, due to change in the circumstances, Y acquiring C and consequently increase in sale of the charger to Y, entity X estimate that price will be 90. Consequently, X will recognize the revenue of 53050. 600 into 90. It will recognize the revenue at a 90 only. And for the earlier charger, it will reduce the revenue. So, revenue recognized for the quarter end will be for new charger at a 90 and adjustment of rupees 10 for earlier charger we have sold. So it will reduce 95 950 from 54,000 and it will recognize a revenue of 53050. So AST Limited enters into a contract with the customer to build a manufacturing facility. The entity determines the contract contains one performance obligation that is satisfied over time. The contribution is scheduled to be completed by end of the 36th month of agreed upon 25 crore, and the entity has opportunity to earn a performance bonus, and the likelihood is 15% bonus, likelihood is 25%, 10%, 40% likelihood, and 5%, 15% likelihood. In addition to the potential performance bonus for every completion, AST Limited is entitled to a quality bonus of 2 crore if a health and safety inspector assign the facility a good star rating as defined by the agency in term of contract. AST Limited concludes that it is 60% likely that it will receive a quality bonus. So in this case, we need to use the probability very based on the we need to estimate the transaction price based on the variable consideration. So in this case we will check what is the probability. 15% bonus will be 3.5% and probability 15% bonus probability is 25%, 10% bonus probability 40%, 5% 20%. So based on this, we need to calculate 15% bonus amount is this and probability is 25%. So this multiply by this will be the amount. Similarly, 10% bonus amount is this, probability is this is the amount. So AST Limited decide to use the most likely amount to estimate the variable consideration with the potential quality bonus because there are only two possible outcomes, 2 crore or nil. And this method will best predict the amount of consideration. The quality bonus, AST Limited believe the most likely amount of quality bonus is 2 crore. So the total amount 25 crore plus 2.2125 crores and 2 crore for quality rating. So total revenue will be recognized 29.125. Next is transaction price allocation. So if there is a one performance obligation, there will not be allocation required. But if there is a more than one performance obligation, then we need to allocate the transaction price on relative standalone selling price basis. And we need to determine the standalone selling price if observable price is available based on the similar customer or similar goods. Then we need to use the observable price. And if it is not available, then we need to estimate the price and we need to estimate the we need to adjust the estimated price based on the market assessment approach, or we can estimate it based on the expected cost plus margin approach, or maybe on residual approach where price is highly variable and price has not been established yet, or we can use the combination of both the approaches. And for the purpose of allocation of discounts, if the standalone price is greater than the promised consideration, it is called discount. So if observable price is available, not available, we need to allocate the discount to all performance obligation, and if it is available, then we need to allocate based on the observable price. Similarly, allocation of variable consideration, we need to allocate variable amount entirely to the performance obligation if the term of variable relate to entities efforts to satisfy the performance obligation, and we need to allocate variable consideration entirely to the performance obligation in the consistent with the allocation of objective. So the amount will be allocated based on the objective. So a seller provides a sale incentive to a customer when entering into a contract. Example of such customer incentive includes free goods or services that seller normally sells or provide as a part of business. So in this case, entity grants free goods to the customer as a part of sale transaction, which it sells separately as a part of its operation. The transaction price is allocated to each separate identifiable promised goods and services. In the current transaction, the total consideration received will be allocated to all elements in the sale, including free goods. Company A sells a photocopy machine for 1 lakh with a contractual understanding that it will also do a maintenance for 5 years. In certain other transaction where the company has sold photocopier machine without maintenance is 80,000. If the maintenance contract is taken, the value is 30,000. How should the revenue should be allocated in this situation? So it will be allocated in the ratio of 80,000 and 30,000. Prime Limited is a technology company and regularly sells software, hardware, H and accessory. So it is selling software, hardware and accessory. The standalone price for these are as below: 50,000, 1 lakh 20,000. Since the demand for the hardware and accessory is low, the company sells H and A together with 1 lakh. So the price of H and A are 1 lakh and 20,000, but the demand is low, so they sell it on a in a combination of 1 lakh. Prime Limited enters into a contract with Jeta to sell these three items as a 1 lakh 50,000. So what will be the accounting treatment for a discount of 20,000? Because standalone price is 1 lakh 70,000. 50,000, 1 lakh 20,000, but it is selling in 1 lakh 50,000. But as a bundle, they sell it at a 1 lakh, 1 lakh, although the standalone price will be 1 lakh 20,000. So we will allocate the 20,000 discount between H and A. Entity Y enters into agreement to sell hardware, professional services, and maintenance services for 2 lakh. Entity Y determined that each of the promised goods and services represents a separate performance obligation because the entity frequently sells professional services and maintenance services on a standalone basis. The standalone price of the professional services and maintenance services are 25,000 and 15,000 respectively. The entity Y rarely sells the hardware on a standalone basis, so the estimate the standalone selling price of hardware 1 lakh 85,000. On the hardware's underlying cost, the entity's targeted cost and the amount of margin entity believes the market will bear. So it is selling at 12 lakhs, but the standalone price is 25,000, 15,000, and on cost basis it is 1 lakh 85,000. The contract price includes 10,000 incentive if the professional services are provided within the 7 days of the delivery. So incentive is earmarked for the professional services. So now there are two questions: how this transaction price will be allocated to the performance obligation, and what will be the accounting treatment for the incentive amount. So in this case, in the given case, since the professional services and maintenance services are directly observable, the standalone selling price of this obligation will be considered 25,000, 15,000, and on cost basis, it will be considered for 1 lakh 85,000 for the hardware, and accordingly it will be allocated in a ratio of 1 lakh 85,000, 25,000, and 15,000, and 10,000 incentive that is earmarked for software only for the services only, professional services, so it will be allocated to the professional services. So if there is change in the transaction price, so if reason maybe if any uncertainty is resolved, so we need to allocate it based on the same inception as no relocation to standalone price, and only if there is a modification, then we need to do as a variable part pre-modification allocate to old performance obligation. For example, if there is a contract build brace for 100 lakhs and customer at 10 lakhs bonus after the completion, so work has already been finished, so we need to recognize 10 lakhs as a revenue immediately after prior performance obligation. So we need to treat it as a contract modification and not simple change in the price. Second example is if contract is to deliver 5 machines at rupees 10 lakhs each, 50 lakhs, and customer agrees to pay extra 5 lakh for faster delivery. So this 5 lakhs is for to be allocated for last 2 machines only, not to spread on 5, because this is for the fast delivery of 2 machines. Next is price is high due to modification. Original contract is 10 lakhs 10 units at the rupees 1 lakh per unit. Later customer order 5 more at current price. So we need to treat it as a custom contract modification, not simple change in the price. And accordingly we should treat it. So the when there is a price change, we need to think if general rule is spread like at inception, if clearly linked with performance obligation, one performance obligation allocate to debt only. If scope or term has changed, we need to follow the contract modification rules as we have discussed earlier. So fifth is when we need to recognize the revenue. So in India's 115, it says that when control has been transferred, we need to recognize the revenue. So control can be transferred in two ways. One is over the time, another is point in time. So in over the time, first we need to check whether it has been transferred over the time. So to transfer control over the time, we need to check the conditions and recognize a contract is satisfying any one of them. Whether customers simultaneously receive and consume benefits, or another entity not need to reperform the work completed till date. For example, routine recurring services, cleaning services, newspaper services, like this, monthly internet subscriptions. Second is if entities work create or enhance an asset that is controlled by the customer. For example, control of work in progress with the customer. For example, construction or custom at the customer's land. So it will be called as a control transferred over the time. Third is if entity's work does not create an alternative asset and entity has right to payment for the work done. And it happens in case where asset is of a specialized nature and there is no alternative use. Entity has enforced right for the payment for the performance that it has completed. Examples are if building a customized aircraft or bridge or government project. No alternative use. We need to consider the contractual and practical limitations also. Practical limitation exists if incur significant losses to direct asset for the another user. So it is not having any alternative use. Although it has right to direct the asset to the another user, but it has to incur significant losses to direct it to the another user, so it will not be considered as a ability to direct the use to the alternative purpose. So when we find out that the control is transferred over the time, we need to measure the how much revenue we need to recognize. So it there are two methods. One is the output method, another is input method, and both the method we need whatever we choose based on the best estimate we need to apply it consistently. Output method recognize revenue based on the value delivered. For example, milestones, unit delivered, survey of performance. And in case of input method, it recognizes revenue on resource consumed. For example, costs incurred, labor hours consumed. And in this case, we need to exclude the wasted material inefficiency from the measurement purpose. And we need to recognize revenue only if we can measure progress reliably. And if it cannot measure progress reliably but expect to recover cost incurred, recognize revenue only to the extent of the cost. And if there are changes due to the change in the estimate, so we need to recognize it based on the Ind AS 8. And if we find out that control is not transferred over the time, it will be transferred in the point of time. So indicator may be if the customer has right to the payment, if the legal title has been transferred, it is physical possession is there, risk and rewards of ownership are there, and customer acceptance is there, it will be called as a control transferred point in time. Next is the contract asset. So it is an incremental cost of obtaining contract. If it would not have incurred if contract is not obtained, so these cost we will recognize as asset. And only when we expect to recover these costs and amortization period is more than 1 year. So we will recognize incremental cost as a cost of obtaining contract. For example, company A is in telecommunication company that pay discretionary annual bonus to its employee of the sale department based on the annual sale target and the employee's rating. Will the annual bonus will be incremental cost of obtaining contract? No. First condition is that these costs would not have incurred if contracts not obtained. So these bonuses are not directly attributable to identifiable contract. Next is company X provide consultancy services to its customer and it has won a contract through a tender process and incur following cost. What are the costs? That legal fees 15 lakhs, travel cost 25 lakhs, commission to sale employees 10 lakhs, and total cost incurred 50 lakhs. So in this case, if we check the first condition, that incremental cost of obtaining contract, we would have incurred the legal fees whether contract has obtained or not, so it will not be considered. Travel cost we would have incurred. Commission, this is the cost that would not have incurred if we could not have obtained the tender. So 10 lakhs will be considered as an incremental cost. 10 lakhs will be considered as an incremental cost and will be booked as a contract asset. Next is company X pays 10% commission to his salesperson on the contract that he obtains. In addition, the following employees of the entity receive sales commission on each signed contract negotiated by salesperson, 3% to the manager, 1% to the regional manager. So in the given case, all the commissions are the incremental cost because the commission would not have incurred if contract has not been obtained. So, Ind AS 115 does not distinguish between the commission paid to employees based on the function or the title of the employee. The receive commission, it is entirely that decide which employee are entitled to the commission as a result of obtaining contract. So, it will be booked as a asset. Next is cost of fulfilling a contract. So, we need to recognize asset if it does not fall in Ind AS 2, 16 and 38, and there are again three conditions, that it is directly attributable, directly related to the specific identifiable contract, and that is include cost specifically chargeable to the customers, cost generated, enhanced resources that will use in satisfying the performance obligation, and cost are expected to be recovered. and we need to amortize it systematically in the period of contract, and basis will be pattern of transfer of related goods to the service to customer. And if there is a change in estimate, we need to book as per Ind AS 8. Example is setup cost of 12 lakhs for a 3-year software. So we need to 3-year contract. So we need to amortize 4 lakhs each year. If contract revised to 2 years, then we need to amortize 6 lakhs per year. And we need to impairment loss should be recognized if carrying amount is increased, is greater than the expected consideration less direct cost. For example, carrying amount of fulfillment cost is 50 lakhs, remaining expected consideration is 40 lakhs, future direct cost is 10 lakhs, so net is 30 lakhs. So we need to recognize 20 lakhs as an impairment. And there will be reversal of impairment if the condition improve, but limit is it cannot exceed the carrying amount that would have been existed if no impairment could have incurred. For example, in the earlier example, if the asset impaired to 30 lakhs, next year we expect the consideration improve to 50 lakhs and cost will be 10 lakhs. So net will be 40 lakhs. So reversal can be up to 10 lakhs, not beyond the amortized carrying amount had no impairment occurred. So there may be some cases where we have sold the material with a right to return. So we need to recognize revenue as per the substance of the arrangement. So how to recognize? So we need to recognize three things on the sale date. First, the revenue only for the goods we don't expect to return. Second, we need to recognize the refund liability for the expected amount of return. And third is we need to recognize the return asset. That is right to recover the goods of inventory. Goods or inventory back. So we will recognize three things. First, we will recognize the revenue. Second, we will recognize the refund liability. Third, we will recognize the return asset. So for remembering, there are three R's: revenue, refund liability, and return asset. So key characteristics are that standing ready to accept return, not a separate performance obligation. We need to recognize it as a refund liability, and estimate revenue using variable consideration rule, and we need to update the refund liability at each reporting date, and we need to book the return asset, measure at carrying amount of goods less expected recovery cost or impairment, and simple exchange of the goods with the size, color, same price. Suppose I have purchased one refrigerator of gray color, I want to change it to a blue color or black color. It is not called as a return. It will be considered as a only change of the asset, will not be booked as a return. And defective to functional replacement, we need to consider it as a warranty. So let's take one example of it. For example, 100 mobiles were sold at the rate of 10,000. So 10 lakhs is the amount. Cost per mobile is 7,000. Return period is 10 days. At a sale date, we expect that there will be 5 units will be returned, 5% will return. At the end of the return window, actual return is 3 units. So it is a sale with a right to return. So we need to recognize three things, three R's. One is the revenue, one is the refund liability, one is the return assets. So revenue will be recognized for 95 mobiles because we are thinking that 5% will be returned. We will recognize refund liability for 5 units. We will recognize COGS for 95 units. We will recognize return assets for 5 units. So accounting entry will be customer will be debited for 10,000 mobile into 10,000, 10 lakhs to revenue by reducing the return estimate of 5% with 9 lakh 50,000, and we will recognize the refund liability. So 3R we have recognized: revenue, refund, and liability. Then we need to recognize the COGS. COGS we will recognize for 95 units. So cost per mobile is 7,000. So 7,000 into 95, 6,65,000 COGS we will recognize. Then there are 5 more units that we will recognize as a right to return asset. So it is debited and inventory will be created by total 100 units. For 95, we have recognized the COGS, and for 5, we have recognized the return. Now, at the end of the return period, only 3 units were returned. So we will book a return for 3 units, and 2 units are not returned. So we will reverse the refund liability for 5 units. For 2 units, we will increase the COGS and will increase the revenue. And for 2 units not returned, we will increase the revenue as well as COGS, and 3 units, those has been returned. We will increase the inventory and will reduce the return asset for the 3 units. So accounting entry will be record refund to 3 units, those were returned. Refund liability we have created, so we'll debit this liability for 3 units and bank will be credited. And for 2 units, we will reverse this liability, return liability debit, and we will increase the revenue. So 50,000 credited is debited by 50,000, 30,000 here, 20,000 here. And 3 units we will take into the inventory. So inventory will be increased and return asset that we created here will be created by 2 units and for 3 units, and for remaining 2 units those have not been returned, we will increase the COGS and return asset will be created. So return asset is also cleared. It was 35,000 balance here, so it was created by 21,000 here and 14,000 here. So this balance is clear, and return liability credit balance of 50,000 was also cleared. For 3 returns we debited 30,000 refunded, and 20,000 we booked the revenue. Next is warranty. If there is an option, whenever we are anyone selling the product in the market, there is a normally there is a legal liability to provide the warranty. So we need to check whether there is an option to purchase warranty separately. If there is a option to purchase warranty separately, the seller need to recognize it as a performance obligation. If there is no purchase warrant not available to purchase it separately, so we need to check whether there is a something additional to the assurance of the product functionality. If there is no additional to the performance assurance, we need to recognize it as a performance warranty. And if yes, it is assurance also apart from something that also, that then we need to recognize that as a performance obligation, separate performance obligation. For example, an entity manufactures and sells computers that include assurance type warranty for first 90 days. The entity offers an optional extended coverage plan under which it will repair and replace any defective part for 3 years from the expiration of assurance type warranty. Since the optional extended warranty plan is sold separately, the entity determines that 3 years of extended coverage represents a separate performance obligation. The total transaction price for the sale of a computer and extended warranty is 30,000. The entity determined that the standalone selling price of the computer and extended warranty is 32,000 and 4,000 respectively. The inventory value of computer is 14,500. Furthermore, the entity estimated that based on this its experience, it will incur 2,000 in cost to repair defects that arise within 90 days coverage period. So here we need to check the entity will record the transaction as below. We'll debit the trade receivable for 36,000, and there is a warranty expense because it is a assurance type of warranty, so we will book it as a expense. And we need to recognize the liability also for 2,000, and the extended warranty 4,000 we need to recognize, and revenue will recognize by 32,000. So cost of goods sold we will recognize with a 14,000 value, 14,400. The inventory value is 14,400. So we'll recognize the COGS with 14,400 and we'll reduce the inventory to 14,400. Next is principal versus agent consideration. So we need to check here when the control of goods is transferred. So if the when we are selling to a particular party and we have not transferred the control over the goods, so it will be considered as an agent. And if yes, we have transferred the control, then it will be considered as a principal. So indicator of principal may be that entity is principally responsible for the fulfilling the promise. For example, primary responsibility for meeting the customer specification lies with the entity. If entity carries the inventory risk, for example, if the customer has right to return, entity has ability to direct the use of and obtain all the remaining benefits from the goods and services before it transfer to the customers. And if entity has discretion in establishing the price, in some cases agent may also have the discretion. So these are the indication. Based on that, we will decide whether it is a principal or agent. So the accounting will also flow in the same way. So let's discuss some example. So if the promise to provide goods and services is owned by the entity, it will be called as a principal. And if it is with the third party, it is agent. If the control over goods before transfer to the customer lies with the entity, it will be called as a principal. If there is no control, it's called as an agent. If revenue in case of principal will be on gross value, however, in case of agent, it will be on commission basis only. For example, I am booking a flight ticket and the ticket provider is only facilitating in providing the ticket booking. In that case, the facilitator will book its income with the commission amount only. And if the responsibility regarding the fulfillment of promise and quality lies with the entity, it will be principal, else it will be an agent. And risk, inventory risk, return risk borne by the entity, it will be called as a principal. Otherwise, it will be called as a agent. And pricing, mostly principal sets the price, but in some cases agent may also have. So we need to check case to case basis. So if you control the price, risk, you are principal. If you don't connect, if you just connect with the customer to the supplier, you are agent. Next is customer option to buy additional goods. So sometimes there are offers in the market for the reward points, credits, and sales incentive, contract renewal options, and future goods and services. In that case, we need to check whether these are having the material rights to the customers. If yes, then we need to book it as a separate performance obligation, and if there is no metal right, in that case it need to be booked as a marketing of offer only. So if it is a separate right, then we need to allocate the transaction price between the standalone price and estimate and likelihood of the exercise of that right with the incremental discount. So performance obligation, we need to recognize a contract liability. We need to book it on based on the surety or to exercise it right. So by that amount, we will recognize the performance obligation and we will check the probability to exercise that right. So on proportionate basis, we will book it. For example, A Limited on 20 resorts across the India. Every customer who stays in one of the resort, any one of the resort owned by A Limited is entitled to get points on the basis of total amount paid by him. Under this scheme, 1 point is granted for every 100 spent stay in the resort. As per the past experience of A Limited, likelihood of exercise of the point is 100% and the standalone price of each such point is 5. So customer spent 10,000 one of the resort of A Limited and earned 100 points. So 500 rupees he earned. What is the accounting treatment for the points granted by the A Limited? So in that case, there are two performance obligations. Customer gets additional material right by way of discount of 500 for 100 points. He would not receive without previous stay in the resort. Thus, the customer in effect pays the entity in advance for future goods and the entity recognizes revenue when goods are transferred. So, in this case, the standalone selling price for 100 point is 500. A Limited should allocate the fair value of consideration, that is 10,000, between the points and the other component of the sale. So, it will be allocated between two performance obligation whose standard selling price is 10,500. So 500 will be allocated. So revenue will be booked for 9524 and 4776. It will be booked as a obligation. So option PO, performance obligation only if it gives a metal right. Otherwise, it's just a marketing right. Next is, if there are non-refundable upfront fees. For example, there may be joining fees and activation fees or setup fees or initial fee. So in this case, we need to assess, does the fees provide a distinct services or goods? If it provides distinct goods and services, then we need to treat it as a separate performance obligation and we need to allocate the part of transaction price and recognize revenue when services are delivered. Examples are, if we are getting air lounge access and one time training, so we need to divide it in separate performance obligation. And if not, fee is a advance payment and we need to recognize it as a contractual liability and should spread over the contract term. For example, gym joining fees, telecom activation fees, etc. So upfront fees are usually the advances, not revenue. And we need to ask, does it give a distinct service upfront? If yes, that then it is a separate performance obligation. If not, then we need to spread it over the contract. For example, so, Supernet is into a business of providing fiber connectivity. It lays the fiber from nearest point of connection of telecom companies to the housing society, where each house can obtain data connectivity. It charges a non-refundable upfront charge of 300 per subscriber and a monthly charges of 1,000 per subscriber. The upfront fees are one-time cost of laying the cable to home, charges of agency which does outsource work, administrative setup cost, etc. How should Supernet Limited recognize the upfront charges? Based on the past experience of the company, it estimate that the expected life of customer is 3 years. So in this case, fees is not for providing separate performance obligation. So we need to amortize it as a revenue over a period of 3 years. Next is the licensing. So in case of license, we need to assess whether it is a distinct services or not distinct. So whether it is a right to use or right to access. It is having right to access if entities activities will significantly affect intellectual property to which customer has right. For example, existence of shared economic interest, share based sale based royalty. Entities activities will expose customers revenue, significant change the form, design, content, functionality of IP, or these activities don't result in transfer of goods and services. So in this case, if it is distinct, it is a right to access, then we will need to recognize performance obligation over the time. And in case it is not distinct, it is not a right to access but a right to use. In this case, we will recognize revenue in point in time. Next is if there is a consignment arrangement. For example, indicator of consignment arrangement is that product is controlled by the entity until the sale. Entity is able to require the return transfer of the product to the third party, or dealer does not have unconditional obligation to pay, although it may require to pay a deposit. For example, A has given 50 units to B, that if sale happens, then you give me the sale price back, else you return the material. So in this case, the control has not been transferred. So we need to check whether the control has been transferred or not. If control has not been transferred, in that case, performance obligation is not satisfied and revenue will not be recognized. And in case when the control is transferred, we will recognize the revenue. So consignment means the shipment is not considered as a sale, but we need to ask who controls the goods before end user and customer sales. So if consigner, then we need to keep as a inventory. No revenue will be recognized. Revenue will be recognized similarly when the control has been transferred. Similarly, in case of bill and hold to arrangement, these are the cases where entity bills a customer for product but retains the physical possession of the goods. Here also, although the physical possession is with the customer or with the seller, we need to check whether the control has been transferred or not. If control has been transferred, we will recognize the revenue. If control has not been transferred, we will not recognize the revenue. For substantive reason for what is the reason for billing but holding the arrangement. We have billed the material but has hold the material with us. So there may be a reason that customer is not having space. He has purchased the goods but he has requested that you please keep the material with you. So in that case, we will check if we have control the transfer. Then we will recognize the revenue. So ultimate uh, test point is that whether we have transferred the revenue control or not. So in case, for example, next is customers acceptance. This is also important in transferring, in judging the transfer of control. But if the specification can be objectively tested, so customer acceptance is just a formality. In this case, we will recognize the revenue. If specification are not objectively tested, it is on customized ways. In that case, we will recognize the revenue on the customer's acceptance only. For example, customers customized software and subjective features are there. And in case of trial and evaluation, it will be on acceptance or end of the trial. For example, if there is a 30 days trial period, then we will recognize it day after. And similarly, there are some requirement about the disaggregated revenue. So we need to recognize the revenue in categories to explain how nature, amount, timing, and uncertainty about it. So there are different, the reason basis for choosing the category is that there should be consistency across the internal, external and financial reporting. So idea is to consistent across the internal, external, financial reporting purpose. There are some service concessional agreements also, like infrastructure, road, bridges, hospitals, airports, water, power, telegram. Those are traditionally run by government, but now government invite private sector also to construct and upgrade these infrastructure. So the common model are build and operate, where the private sector build also and operate also, and some is on the rehabilitate operating transfer. So at the end, operator must hand over assets to a government in agreed condition. Only then service concession arrangements will be applicable. So scope, This appendix applies where both the conditions are satisfied, that it is controlled by the government, that services will be provided to whom at what price it is decided by the government, and grantor control residual interest also. So ultimately at the end of the arrangement, the asset will be transferred to the government. So it includes new and upgraded assets, it includes existing assets and whole of the life of the asset. But it excludes the assets already owned by the operator, and grantor's accounting is not covered here. Only operator's accounting this appendix talks about. So the core accounting principles are that operator will not recognize infrastructure as a PPE because control is with the government, and it is having only access to operate it, not to control it. So in case of consideration for construction or upgrade, so it will be recognized in two way. One is the financial asset, another is a intangible asset. So it will recognize it as a financial asset if it has unconditional right to receive the cash from government. The guarantee payment is fixed, and it will be recognize it as an intangible asset if it has a right to charge to the users, or there may be mix of both of the methods, split and account separately. So it will be recognized accordingly. Apart from it, the O&M, operating and maintenance services, also accounted for as per Ind AS 115. Restoration obligation, if is there, that at the end of the contract, the asset has to be returned back in a particular situation to the government. In that case, it has to recognize a liability according to Ind AS 37. Similarly, in case of borrowing cost, if consideration is a financial asset, borrowing cost is expense. If it is a intangible asset, it will be capitalized. And for financial assets accounting, we need to check for 32, 107, and 109. And intangible asset, it will be accounted for as per 38. Items for grantor, if government gives some item, it will be considered as a part of revenue as we have discussed earlier. It will not be considered as a government grant. And we need to check the control test. We need to apply two conditions: whether grantor control, what type of services will be provided, at what price it will be provided, and to whom it will be provided, and residual interest, ultimately asset to be given to the government. And even if the operator manage day to day, grantor still controls. And there may be mixed use infrastructure if part of infra is separable and used for unregulated purpose. For example, private wing cafeteria, we need to treat it as a separately. We need to separate the financial obligation, and it may be lease if grantor allows a operator's own control. So hook is that if government guarantees cash, then it is a financial asset. If income depends on a traffic, then it is an intangible asset. And operator never owns the infra, only it has right to operate. So this is all about the Ind AS 115 that we have discussed, although cannot be say in detail, but yet I have tried to explain all the concept of Ind AS 115. Some concept is still left because of the lack of the time. So we'll discuss them separately. And if you have any questions or need any clarification on any topic, you can contact on the given WhatsApp number. So it will be helpful for you for understanding. Thanks a lot for watching it. Namaste.